Usually, fixing a struggling business means, well, building an empire.
All right.
Like the traditional playbook always dictates that making more money requires opening more stores.
Yeah.
Expanding the map and just kind of saturating the market with your brand's physical footprint.
Yeah, absolutely. I mean, we've basically been conditioned by, the last decade of zero interest rate policy to view aggressive expansion as like the only proxy for corporate health. That whole growth at all costs model just became the default metric for success.
Yeah.
For everybody.
But, and this is why we're doing this deep dive today, if you look at the Q1 2026 earnings call for Noodles Company.
Ticker symbol NDLS.
Exactly, NDLS. That entire playbook just gets completely flipped upside down.
Yeah.
I mean, we are looking at a company that literally shrank its way to a massive profit leap.
Which is fascinating. And, our mandate here at Talk Tickers is to dissect these earnings transcripts for you, the retail investor.
Yes.
So today, our mission is really to tear apart the mechanics of how a fast casual chain managed to post, totally flat top-line revenue, but somehow simultaneously orchestrate this massive turnaround in profitability.
Just by aggressively pruning its operations. It's wild.
It really is.
So let's just get right into the data drop at surface level data. Total revenues were practically frozen at $123.8 million.
Right. Basically flat.
Yeah. If you just glance at the top line, the company appears entirely stagnant, like nothing is happening.
Yeah.
But the mystery really begins when we look at the underlying unit economics.
Specifically, the system-wide comparable restaurant sales.
All right.
Because this is the core contradiction we need to untangle today. Total revenue was flat year over year, yet system-wide comp sales jumped by 9.1%.
9.1.
Yeah. And if we break that down by ownership structure, the company-owned restaurants were actually up 9.4%.
Oh, wow.
And the franchise locations were up 8%.
Okay, so to put that in perspective for you guys listening, the bottom line saw a net loss of $3.4 million, which translates to a loss of 58 cents per share.
Right. Which doesn't sound great on its own.
It doesn't. But contextualizing that against the historical data totally changes the narrative. Because in the exact same quarter last year, they posted a net loss of $9.1 million.
$1.58 per share.
Exactly, $1.58. So they essentially erased 2/3 of their net loss without adding a single dollar to the overarching top line. How is that even possible?
Well, that brings us to the adjusted EBITDA figure, because that more than tripled from last year.
Tripled.
Yeah, it climbed from $2.4 million in Q1 of 2025 all the way to $7.7 million this quarter.
Okay, that is a massive jump.
It is. And, we also need to factor in that their current $3.4 million net loss actually included a pretty big non-cash impairment charge.
Right, the $2.7 million charge.
Exactly. It was a one-time accounting maneuver that was directly related to the closure of their underperforming restaurants.
See, that impairment charge is like the smoking gun of this entire earnings call.
Yeah.
The mechanism driving this apparent contradiction, flat revenue against soaring same-store sales, it's the deliberate shutdown of 23 underperforming restaurants in the first quarter.
Right. They closed 20 company-owned locations and 3 franchise locations.
And the industry colloquially refers to these as zombie locations, right?
Zombie locations, yes. They are basically the physical manifestations of overexpansion.
Like from the 2010s.
Exactly. During the 2010s, fast casual chains just aggressively signed commercial real estate leases in really suboptimal trade areas, honestly, just to appease Wall Street's demand for unit growth.
Right, because Wall Street just wanted to see new pins on the map.
Exactly. But a zombie location doesn't just fail to make money. It actively destroys value across the board.
How so? Like beyond just the rent?
Oh, it drains regional management's time, for one, and it introduces huge supply chain inefficiencies.
Oh, because the delivery trucks still have to go out there.
Right. Delivery trucks have to make a stop for a low-volume drop-off, which costs fuel and time. And it dilutes the brand standard, too, because underperforming stores almost always struggle to retain top-tier kitchen staff. It's just a drag on the whole system.
Okay, but breaking a commercial lease is incredibly expensive.
Oh, very. Which is exactly why that $2.7 million impairment charge popped up on the ledger. Management basically had to absorb that near-term financial hit, paying to break those leases just to permanently sever the operational drag.
Okay, I want to push back on this a little bit, though. Let's really challenge the optimism around this metric.
Sure, lay it on me.
Let's use like a mechanical analogy. If you run a manufacturing plant with 10 assembly lines, right? And 3 of those lines are just constantly breaking down, producing defective parts, losing money. If you shut those 3 down, your plant's overall efficiency average is going to look so much better on paper immediately.
Right, because you remove the drag on the denominator.
Exactly. But shutting down the bad assembly lines doesn't automatically mean the remaining 7 lines are running any faster or producing better parts.
That's a fair point.
So if you simply chop off the bottom tier of your real estate portfolio, your same-store sales will mathematically rise. So I have to ask, is this 9.1% jump just a statistical illusion? Or is the core business actually getting healthier?
It's a great question, and honestly, the institutional analysts on the call zeroed in on that exact vulnerability. They wanted to know the exact same thing.
And what did the data show?
While the internal data reveals that the remaining locations are in fact generating significantly more organic demand.
Really?
Yes. Company comp foot traffic actually increased by 4.8%.
Wait, foot traffic was up nearly 5%.
Yeah, and the average check increased by 4.4%.
Wow. Because, I mean, in the current macroeconomic environment, fast casual chains are generally bleeding foot traffic.
Absolutely bleeding.
And they're relying almost entirely on just really aggressive menu price hikes to pad their top line.
Yeah.
So a 4.8% increase in actual human beings walking through the door is highly anomalous.
It is. And furthermore, their chief financial officer, Mike Hines, he explicitly stated that only 2% of that check increase came from effective pricing actions.
So they barely touched their menu prices.
Barely touched them. A 2% hike is basically nothing right now. The remainder of that check growth came from what they call mix.
Mix. So guests are just organically choosing to purchase more items.
Yeah, more items per transaction, or they're trading up to higher margin premium items. They're just spending more by choice.
Okay. But during the Q&A portion of the call, I remember Todd Brooks, an analyst from Benchmark Company, he really pressed management to isolate the impact of those store closures.
Oh, yeah, he was not letting them off the hook.
Right. He wanted the exact breakdown of how much of that 9.1% comp growth was just cannibalized traffic.
Which is a valid concern.
I mean, if a location closes, don't the customers just drive a few miles down the road to the next closest Noodles Company?
They do, and management actually quantified that transfer effect at approximately 250 basis points.
Okay, so that's 2.5%.
Right.
So 2.5% of the growth was just transferred loyalists driving down the street, which leaves the vast majority of that 9.1% increase driven by genuine, fundamental improvements within those surviving stores.
Exactly. And the operational modeling behind that 250 basis point transfer is really crucial for you to understand if you're looking at this stock.
Break that down for us.
So fast casual chains use highly sophisticated geospatial data to map their trade areas. They know exactly how far a customer is willing to drive for a bowl of pasta.
Down to the minute, probably.
Exactly. By deliberately closing stores that sat on the overlapping edges of these trade areas, they essentially engineered a consolidation of demand under fewer roofs.
Ah, I see. So the top line revenue stays flat because the exact same total volume of food is being sold across a smaller geographic footprint.
You nailed it.
Which naturally leads to the immediate question of, well, how did management convince those existing customers to buy more? And how did they attract new foot traffic without relying on aggressive price hikes?
Right. And to map out that customer acquisition, we have to examine their culinary strategy and their marketing execution. Because CEO Joe Cristina detailed this really interesting multi-pronged approach on the call.
Starting with the fresh campaign, right?
Yes, the fresh campaign.
Which is fascinating to me. Because for a brand historically associated with heavy carbohydrate-dense comfort food, like mac and cheese.
Right, very heavy.
Pivoting the marketing language to emphasize daily kitchen preparation and ingredient quality, that feels like a highly calculated move to elevate the perceived value of the menu without actually changing the core offering.
Oh, it's brilliant marketing. But they didn't just stop at brand messaging. They paired that overarching campaign with a highly tactical loyalty initiative that they called Boost Week.
Ah, Boost Week.
Yeah. During a specific winter window, they offered their app rewards members 2 classic dishes for $12.
Okay, stop right there. 2 entrees for $12. That is an incredibly aggressive value proposition in 2026.
It's basically unheard of.
Usually a discount that deep triggers a total race to the bottom, right? It just erodes your brand equity.
It would if they did it the traditional way. But the distinction here lies entirely in the targeting.
Okay.
This was not some mass market television campaign broadcasting cheap food to the general public. It was a precision strike, and it was gated completely behind their digital ecosystem.
Oh, so you had to have the app.
Exactly.
Yeah.
The goal wasn't just to sell noodles. It was to harvest consumer data and force a shift in customer behavior into their proprietary channels.
And did it work?
The results totally validate the strategy. They reported a 36% year-over-year increase in new guest active purchases.
36%.
And a 33% growth in loyalty signups during the exact same quarter.
Okay, that makes sense. Because acquiring a user into a first-party app, that bypasses all the exorbitant commission fees of those third-party delivery platforms.
Yeah, the Uber Eats and DoorDash fees just kill margins.
Right. And once the customer's in the NDLS ecosystem, the brand controls the push notifications, they control the retargeting algorithms.
They own the customer relationship. And Cristina actually indicated that the unit economics of this specific promotion were so incredibly favorable that they intend to institutionalize Boost Week.
Like doing
Make it a repeatable quarterly program. They basically identified a highly reliable lever for customer acquisition, and now they're integrating it into their permanent operational cadence.
Okay, that's smart. But a discount only acquires the customer. The menu itself has to retain them.
Exactly.
Which is where their reliance on limited time offers, or LTOs, really comes into play. From the transcript, it looks like they leaned heavily into their Asian flavor profiles.
Yes, they brought back the Steak Stroganoff.
Oh, class.
And they heavily promoted the Indonesian peanut sauté and the chili garlic ramen.
Which is smart because LTOs function as the primary mechanism for urgency in the restaurant space.
Right.
Like, get it before it's gone.
Right. And during this specific promotional window, their Asian category mix increased by an impressive 40%.
40%. That's a huge shift in consumer behavior.
It is. It demonstrates that the consumer base is actually willing to engage with much more complex global flavor profiles, which, by the way, typically command a much higher margin than standard macaroni and cheese.
Margins. Which perfectly sets the stage for their newest nationwide LTO, the chicken artichoke and asparagus rigatoni.
Right.
But the menu item itself almost feels secondary to the distribution strategy here, because they bundled this dish with a Cravings-inspired crispy treat.
Yes. Officially partnering with Cravings by Christy Teigen.
Right. They branded it the Craveable Bundle. Now, inserting a brand into the cultural zeitgeist via influencer partnerships, that's a standard customer acquisition strategy today.
Very standard. Every fast food chain is doing a celebrity meal.
But it carries a massive upfront capital cost. Licensing a celebrity's likeness and integrating their proprietary product into a national supply chain, that requires significant investment.
It does, which introduces a really glaring paradox in their cost structure for Q1.
Yeah, explain that, because I'm looking at the numbers and I'm confused.
Think about it. We are looking at a quarter where they executed deep discounts via the $12 Boost Week.
Right.
They funded a high-profile celebrity partnership with Christy Teigen.
Which wasn't cheap.
And they navigated a macroeconomic environment where supply chain and labor costs are inherently volatile. Logically, their profit margins should be heavily compressed right now.
They should be tanking.
But instead, their restaurant contribution margins expanded by 460 basis points.
Wait, 4.6%?
Yes, reaching 14.9% overall.
Okay, expanding restaurant-level profitability by 4.6 percentage points in a single year while running discounts and paying celebrities. That is a monumental operational feat.
It's massive.
We really have to isolate the mechanics of that margin expansion for our listeners. Let's look at the two largest line items on any restaurant's P&L, which are food and labor.
Okay, let's start with food.
Let's examine the cost of goods sold, or COGS. It actually fell by 1.2%, dropping to 25.4% of total sales. How did food costs go down?
Well, management did acknowledge a 0.2% food inflation rate, meaning the raw ingredients technically did cost more.
Okay, so inflation is still there.
It is, but they entirely mitigated that inflation through rigorous waste reduction protocols in the commercial kitchens. Mike Hines pointed out that the new menu items were literally engineered for efficiency.
So the underlying mechanism there is ingredient cross-utilization. Like, if a prep cook is slicing artichokes for the new rigatoni dish, but those exact same artichokes can be utilized in an existing salad, the velocity of that ingredient moving through the walk-in refrigerator increases.
Yes, you're turning the inventory over much faster.
And faster inventory turnover means less food spoils before it can be sold, which directly lowers the COGS percentage.
Exactly right. Furthermore, because the organic demand for the core menu was so robust, the company engaged in significantly less overall discounting throughout the quarter.
Aside from the highly surgical boost week, of course.
Right. Aside from that app promotion, they didn't really discount at all, so higher realized check averages naturally suppress the COGS ratio.
Okay, that covers food. But labor is the more complex variable here.
Always.
The company experienced an hourly wage inflation of 1.9%, meaning they paid their employees more per hour.
Yep.
Yet, total labor costs as a percentage of sales dropped by 2.5%, settling at a highly optimized 30%.
Which is incredible.
How do you pay your staff a higher hourly wage while simultaneously shrinking your overall labor expenditure? Doesn't make sense.
The mechanism driving that efficiency is something called sales leverage. And this brings us right back to the strategic brilliance of closing those 23 zombie locations.
Oh, because of the transfer traffic.
Exactly.
Yeah.
Remember those 250 basis points of transferred sales that were forced into the surviving stores?
Yes. Let's map out how sales leverage actually functions on the floor of a restaurant, because I think a lot of investors misunderstand this.
Okay, consider the fixed versus variable cost structure of a commercial kitchen. Rent, insurance, utilities, and, the salaries of the general manager and the kitchen manager, those are fixed costs.
Right. They do not change whether the restaurant serves 100 guests or 500 guests in a single day.
Exactly. The variable costs are the hourly, line cooks, and the raw food. So when the local zombie location closed, those loyal customers transferred their business to the surviving location just down the street. That surviving location suddenly experienced a massive surge in order volume, pushing its average unit volume, the AUV, up by 13.5%.
Up to what, 1.49 million?
Yes, $1.49 million per store.
Okay, I see where you're going with this. When a store's annual revenue jumps from 1.2 million to nearly 1.5 million, the management does not need to hire a second general manager.
Exactly. They don't need to rent a second building. The existing infrastructure simply absorbs the additional throughput.
They might schedule one additional hourly line cook during the peak dinner rush?
Right, maybe one extra guy on the fry station. But the vast majority of the labor force remains entirely static.
Therefore, the total revenue expands significantly, while the total labor dollars spent increase only marginally.
Yep. Mathematically, labor as a percentage of total sales just plummets. The fixed costs are distributed across a much larger pool of revenue, allowing the incremental dollars from those transferred customers to flow almost entirely to the bottom line.
Wow. It is a textbook demonstration of operational consolidation. I mean, they deliberately shrank their physical footprint just to maximize the throughput of their most efficient assets.
That is exactly what they did.
Okay, but look, the historical performance of Q1 sets the baseline. But the institutional market prices a stock based on its forward-looking trajectory.
Always.
Which brings us to the management guidance for the rest of 2026. This requires careful parsing to understand the company's anticipated capital allocation, because things are changing.
They really are. Due to the structural shift in their operating model, management actually actively raised their full year 2026 guidance.
Let's hear the numbers.
They are projecting total revenue to land between $483 million and $498 million.
Okay. And they anticipate the comparison. Restaurant sales growth will sustain a highly elevated pace, right? Projecting between 7% and 10% for the full year.
Right, and the restaurant contribution margin is expected to hold steady between 15.5% and 17%.
And adjusted EBITDA.
That is forecasted to reach between $32.5 million and $37.5 million.
Okay, so while the margin and EBITDA projections absolutely confirm the sustainability of the Q1 operational changes, the most critical data point for assessing the enterprise risk involves the balance sheet.
Oh, 100%. Because Mike Hines confirmed the company expects to be free cash flow positive for the year.
Generating free cash flow fundamentally alters the capital structure of a turnaround play.
It changes everything.
They're no longer burning cash just to survive. They are actually throwing off surplus capital.
And the stated intent for that surplus capital is aggressive debt management. They plan to pay down approximately $10 million in debt over the course of 2026.
Which is huge. Have they started?
Yeah, having already retired $3.4 million during the first quarter alone.
See, in a macroeconomic environment characterized by elevated interest rates, carrying variable rate debt is a massive headwind for corporate earnings.
It's a killer. Refinancing that debt at current market rates would severely compress their net income.
Exactly. So by using organic cash flow to aggressively retire the principal right now, they're permanently destroying future interest expenses.
Right, because every dollar of interest they avoid paying goes straight to the bottom line in subsequent quarters. It creates this amazing compounding cycle of profitability.
This aggressive deleveraging significantly de-risks the stock for retail investors.
It really does. And the momentum supporting this cash flow generation, it appears to be accelerating too.
Yeah. Joe Cristina provided some real-time data extending past the Q1 cutoff, didn't he?
He did. He noted that same-store sales for April, which is the beginning of the second quarter, were already tracking over 9%.
And the company-operated locations.
Exceeding 10%.
That is wild. That data point basically confirms that the Q1 outperformance was not an anomaly driven solely by the Boost Week promotion.
Right. It actually marks 16 consecutive months of positive same-store sales, which strongly suggests the structural shift in consumer habit formation and brand loyalty. People are just coming back.
Okay, so we have dissected the real estate consolidation. We've gone over the margin expansion driven by sales leverage and the strategic deleveraging of the balance sheet.
We've covered a lot.
We have. So to deliver on the Talk Ticker's mandate, we need to synthesize all this data into a definitive verdict on the financial health of the enterprise. Are we flashing a bullish or bearish signal on NDLS?
Well, based purely on the execution of the unit economics detailed in this transcript, the signal on NDLS is heavily bullish.
Heavily bullish.
Yes. We are observing a management team that possesses the operational discipline to actually sever unprofitable revenue streams. They are trading vanity metrics like total store count for actual capital efficiency.
And the 460 basis point expansion in contribution margins proves that the core product is highly lucrative when that geographical bloat is removed.
Exactly. And let's not forget their digital acquisition strategy. It is successfully converting organic foot traffic into owned data, as evidenced by that 36% spike in new active purchases.
Right. So the transition from a cash-burning brick-and-mortar operation to a cash-generating digitally integrated brand is currently well underway. And the commitment to debt reduction fundamentally strengthens the overall equity value.
Absolutely.
But to make this actionable for the portfolio, what should our listeners actually look out for next?
You need to monitor the Q2 earnings release very closely, and with a specific focus on customer retention metrics.
Regarding the Christy Teigen bundle.
Exactly. The craveable bundle drove significant top-of-funnel awareness and trial in April, but the critical variable now is the lifetime value of that specific cohort.
Right, because the Q2 data must verify if the celebrity partnership merely drove a transient spike in one-time transactions, just people trying it once, or if his new customers successfully migrated into the loyalty ecosystem and established a pattern of repeat purchases.
Yes, because if the Q2 transcript shows sustained app engagement from that April cohort, it confirms that their customer acquisition cost is actually yielding durable, high-margin revenue.
Okay, that is super actionable. But I want to leave everyone with a broader thought here. Evaluating the mechanics of Noodles & Company's turnaround provides a highly effective lens for analyzing the broader fast casual sector.
Oh, completely.
Think about it. If a 9.1% jump in comp sales and a massive margin expansion can be unlocked simply by closing 23 underperforming locations,
right,
you should rigorously audit the other restaurant holdings in your portfolios.
It is highly probable that other major chains are currently masking exceptional core profitability by, subsidizing dozens of zombie locations just to maintain the illusion of perpetual footprint expansion.
Exactly. Sometimes aggressively pruning the portfolio is the only way to expose the actual value of the underlying asset.
Addition by subtraction.
Addition by subtraction. Check your portfolios, folks.